Hey everybody, Dr. Joe's in the house, and on this Wednesday evening, hope you are doing fine wherever you're tuning in from. The weather's pretty good here in the Washington D.C. area, and today we're going to focus on money, how to get the money, how to show me the money, as they say. And so we're going to talk about navigating the maze, funding strategies for real estate investors. As we all know, despite what the gurus say, you do need money to do deals. If you're selling a house, the seller wants money. They don't want your words. They don't want your empty promises. They want the money, and so on. A real estate agent is not going to do business with you. They're not going to waste their time trying to find you deals, houses, showing you properties if you have no money. So money is a critical part of real estate investing. We all know that, but sometimes when you listen to some of these gurus, they think you can do everything with no money. Now, with that said, you don't need. It doesn't have to be your money, but money needs to, exchange hands, and so it's very intimidating, especially if you're starting out. And so today's session, we're going to focus on how to navigate that. We kind of broke into three parts. The first part is addressing some of the apprehensions and some of the concerns and fears that people have in terms of money. And then we're going to talk about some of the challenges faced with trying to raise money and how to overcome them. And then the third part, we're going to spend quite a bit of time on some of the do's and don'ts when you're trying to get money. Some of the things to do and some of the things you definitely don't want to do. These are actionable. I think we got 10 do's and 10 don'ts. Okay. So hopefully, if you're trying to raise money, then you want to listen out for those. They're all actionable and all the things that I think will be helpful as you go on your journey to financial independence, as you go on your journey to raise money. So that's the focus of today. It's called Navigating the Maze, Funding Strategies for Real Estate Investors. Just a quick shout out. We had an event on Saturday about landlording at one of my properties. It was really, really good. We had a great turnout. It was a success, in fact. Everybody that came loved it. And we talked about landlording, do a deep dive in terms of what I do, how I'm able to get 5, 10, 15, 20-year tenants. And also we did some networking. We had a sponsor who brought food. Thanks a lot, Nick. And really nice food there. And then we just had a great time. So hopefully I'll be doing one of those again. And when I do the next one, it'll be a different topic, maybe a different house. You definitely do want to come. I think if you didn't show up last Saturday, I think it was really it's your loss. So check it out. The next one that we do. Okay, so let's talk about navigating the maze, funding, raising money, and for your for your deals as a real estate investor. So the first thing we have to do is understand. I think it's important to understand some of the common apprehensions that investors have. Whether you're a new investor, whether you're a big, intermediate investor, or whether you're a seasoned investor, it's scary. It's intimidating trying to raise money, and so we have some apprehensions, some concerns, some fears, and so let's talk about some of those first of all. One obviously is a fear of banks. This big old institution where everyone's in suits and ties, looking very intimidating, and they want everything about you: your credit, your pay stubs, your all the mortgage payments, the tax returns. They want everything. Okay, it's very scary, and so on. So obviously, at the heart of it is the fear of rejection. We're afraid that if we reveal all, we're going to get rejected. When applying for a traditional loan from a bank. So obviously, to mitigate some of that, you want to understand what the banks are looking for in the first place. And so it's almost like you're playing soccer. Before you get into the soccer field, hopefully you'll learn the rules of the game. And so when you enter the field, you stand a better chance of winning. So if you're trying to raise money, you want to understand what the banks and institutions are looking for, and i.e. learn the rules, and then you can prepare yourself such that when you enter the game, you stand a much better chance of winning. So things like credit score is important. They're going to ask for your credit score. That some banks are going to want stable income streams, so they want to pay your pay stubs and prove that you've got if you're self-employed, then probably want to do your tax returns and make sure that you have a stable income stream. And so, as I said before, it's really important to understand what the bank's criteria is, because if you do, then you can prepare yourself accordingly, and therefore you can increase the chances of success. And the other thing is, another thing which I think is a good idea is sometimes it's better to go with local banks, smaller banks, where you can develop relationships, as opposed to this large, you know, big box banks. And the national banks, we all know them, Bank of America's of this world, the Wells Fargo's of this world, the Citibank of this world. These are big, outfits where it's hard to develop relationships. Decisions aren't usually made locally; they're made at another level. So, and everything has to fit into a certain box. Otherwise, it's going to get declined or denied. So there's wiggle room. Okay, there you go. That they have to play with. So, so I tend to go with community banks, smaller banks, credit unions, and where you can develop the relationships. You can take the time to get to know them. They can take the time to get to know you, and hopefully you can start developing a rapport and relationship. And if there's an advocate on your side, then if there's a gray area, hopefully the advocate will be, vouching for you, and therefore hopefully will give you the benefit of the doubt if there's a gray area. Okay, so fear of the traditional bank is one thing. The other one is the fear of interest rates for private financing, hard money lenders, private investors. Typically if you're going to a hard money lender, the interest rates, because they're higher than what you can expect to pay at a bank. Hard money lenders typically will borrow more on, it's more based on the deal as opposed to you. If something goes wrong, they're going to go after the asset, the property, more so than go after. Well, they're still going to go after you, but there's a bit more risk. They usually will borrow you more than a bank would. So there's a certain level of risk that they take, slightly higher than what a bank will do, and because of that, their interest rates are usually a little bit higher. Sometimes you can negotiate, especially if you're a repeat business or a repeat customer. But it's up to you, in terms of, sometimes people don't go there or the people only go there because that's their last resort. And so, paying a slightly higher interest rate is sometimes better than losing the deal. So if that's your only source of income, only source of financing, then it is what it is. I've used hard money lenders before. I've used banks before. And personally, I prefer banks because the interest rates are lower. But I've taken the time to develop relationships in banks. But if I'm just starting out, maybe I don't have any choice but to go to hard money lenders. And you got to start somewhere. And if that's what you can get, then so be it. The good thing about hard money lenders sometimes is that their down payment requirements are a little bit lower than banks, and just generally the ability to borrow money is a little bit easier. I won't say it's it's a little easier than banks, but you still have to qualify. You have to qualify, and also the deal has to qualify as well. And the other, investor apprehension is just the whole fear of down payment money. I don't have enough money. I don't have enough savings. I can't start because I don't have any money in my account. I don't have much money in the account. In these days where prices are getting higher, cost of financing is getting more expensive. A lot of banks now, a lot of institutions are looking for you. They're looking to see if you are liquid. They're looking for you. They're looking to see if you have reserves. And if you don't have reserves, then sometimes they get leery because if something happens, they want to make sure that you're able to withstand those challenges and still be able to keep going. So limited down payment is obviously a concern that people have. So if that's your situation, then you got a couple of choices. You can explore what we call partnerships. There are people out there who have money. There are people out there who are a bit more liquid than you are. And therefore, it may be worthwhile to explore and try to create a win-win scenario whereby they can fund part of the deal, and in exchange for something else. It could be a piece of the action, it could be a return on the money, and you may want to do a joint venture. Again, joint ventures allow you to split the deal. Some of the so they essentially they're equity partners. Private investors, at least how I use private investors, they tend to be more debt financing, so they get a return on their money, but it's still my deal 100%. A joint venture with an equity partner, you split the profits, based on whatever you agree on. It's 50-50, 60-40, 70-30, whatever it is. Okay. And if you don't have money, there's sort of crowdfunding platforms where you can, where people can tap into that in order to, to raise money. It's an option. I've never done that myself, but I know some people do. And there are like-minded individuals out there who get it, and they've got some money, and they're looking for a return on that money, and so they pool their monies together through crowdfunding platforms and so on. Okay, so these are some of the 3 fears or apprehensions that a lot of investors have in order to just even start. And then what we're going to talk about next is the common challenges that we have, or investors have, and how to overcome some of those challenges. Okay, so we talked about the fears, and now we're going to talk about now that you've got over those fears, the next thing is there are some challenges that you're going to have to deal with, and you have to overcome them, and that's what we're going to talk about next. Okay, so the first thing is sort of building, how to overcome the fear of money. Build a strong financial portfolio. Okay, that's quite important. It means that you got to have some reserves. It means that you got to have some assets. You may have some stocks, bonds, securities. The idea is that you have a financial basis from which lenders can see that you have some, you're liquid to a certain extent. Okay, so obviously you want to do is to regularly review your portfolio. If you have a financial advisor, especially those financial advisors that are somewhat comfortable with real estate investing, they can advise you as well on what you to do, how to position yourself such that your financial standing is improved. And then the next thing is, sort of creative financing options. That's an option for some people. Like lease to own. Another one will be seller financing, like subject to, where the lender is providing the financing for the deal, and they offer a bit more flexibility. And so, I've done that a few times, subject to, where you take over somebody else's loan. And so essentially the lender is funding the transaction because you're not getting a new loan, you're taking over an existing loan. And then obviously you have to pay the lender some money for their equity if they have equity. So, most lenders will not entertain that. Most lenders, all they want is their money. But sometimes you can convince them that it makes sense to do, seller financing. For example, you can convince them that rather than getting a lump sum of money through a traditional sale, maybe regular payments, is a viable alternative. They don't need all the money, but they prefer regular, consistent payments. $1,000, $2,000, whatever it is a month, as opposed to a new loan or a lump sum of money. So again, different sellers have different needs, and if you speak to a seller, they may be okay with monthly payments as opposed to lump sums, as they would happen during a traditional sale. So obviously, if you're going to do those creative financing strategies, subject to, lease options, and seller financing, you want to go to an attorney or make sure you have legal representation who understands how that's done, and they can structure the transaction, structure the paperwork in such a way that everybody understands what they're getting into, and making sure that it's done properly. The other thing is that challenges, overcoming challenges, especially with money, if you don't have money, is to explore self-directed IRAs or 401ks. There are quite a few different options there. I have self-directed IRAs. I have several, in fact, and they can allow you to tap into those funds to do deals, i.e., especially if you want to borrow money to other people. So you can borrow your money to others and get a good return on that, or other people can borrow their monies to you. And so therefore they can sort of fund or finance part of your transaction. So if you are short of money, there are people out there who have money. It may be buried in their 401ks, and then you need to transfer it over to what we call a self-directed IRA. And there are certain what they call custodians out there who can play that role. And so through those custodians and intermediaries, you can tap into the funds that these folks have. Okay. Again, when I get private investors, quite a few of my private investors have money in their self-directed IRA, and so they fund my projects through their self-directed IRAs. And then when I'm complete, the project's finished, I then return the money back to their self-directed IRA. So it's it's a good way to fund deals. Obviously, there are rules, there are regulations, especially IRS regulations, that you have to adhere to. And that's why you want to go through what we call custodians, third parties who understand what the rules are, to make sure you don't fall foul of those rules, and so on. So you have to be, very cautious and make sure that it's a seamless transaction from start to finish. Okay, so now we're going to talk about what I call the do's and don'ts when approaching lenders for real estate investments. Okay, so now we've talked about the fear of, we've talked about sort of understanding some of the apprehensions that people have. We've talked about some of the challenges people have as it pertains to raising money and how to overcome them. And now we are now ready to make our loan applications to the banks, to lenders, to financial institutions. Okay, so we're going to now go more tactical and talk about some of the do's and don'ts when approaching lenders for your real estate deals. Okay, you follow me? So we're going to now talk about the do's and don'ts. We're going to start with the do's first, but before we get too far, if you got some questions, anything to do with real estate, please put them in the chat box, in the comments, and I will do my best to answer them during the Ask Dr. Joe segment, which will be in about another 10-15 minutes. So if you got anything to do with real estate questions, please put in the chat box and I'll try and get to them very, very shortly. It doesn't matter, anything to do with real estate, pick my brain, try and stump me. I'll do the best to answer them for you. You want to leverage on my 35 plus years experience, so that way you can avoid making what I call unnecessary mistakes. Okay, so get your questions together. Please put them in the chat box and I'll try to answer them very, very shortly. So let's talk about some of the do's first when approaching lenders. Do understand your credit score. You've got to understand your credit score because there's a pretty good chance the lender is going to check your credit score. Okay, so take the time to go look. And in fact, you should regularly look. There's free services out there that you can tap into. I think one is Credit Karma. That's the one I use. And there are also some paid ones like My FICO. Experian has one, TransUnion has one. All the big credit bureaus have their own programs which you can subscribe to, and they will give you your credit score, and they'll also offer what we call monitoring services. So whenever there's a change to your credit score, they'll notify you. Whenever there's an inquiry, they'll notify you. Whenever there's a significant increase or decrease in your credit report, they'll notify you and things like that. Okay, so they do both the credit score and what we call credit monitoring. So you want to monitor your credit report and keep track of it and make sure you do what you got to do to keep it up. Okay. Obviously, the higher the score that you have, the greater the chances of getting approved by lenders, because it demonstrates to them you're a good steward of your money. And if you're a good steward of your own money, there's a pretty good chance you're going to be a good steward of their money. Okay. So that's number one. Another do is create a solid business plan. What do I mean by that? Is that you want to, if you're going to approach lenders, you want to let them know who you are, what you're trying to do, and two different levels. There's a high level, which is to explain who you are, your background, your history, your experience, talk about your team and things like that. And that's what I call call it a credibility kit, if you want to call it that. A credibility kit, yeah. So credibility kit is designed to establish your credibility. That's on a higher level. And then you have a more detailed level where you focus on what I call a specific project. So let's just say you found a project now at 123 Main Street, and you want that project to be funded by somebody. Okay. Then you want to have a plan or a document that focuses on that specific project. So they'll have an idea more about the project, the background to the project, what you're going to do for this project, what's the exit strategy for this project, what are the numbers for this project, and so on. So it's more specific to the deal because you're looking for them to fund this deal. Okay, so there's two levels of business plans. One is a high level, which is establishing your credibility plan. And then the next one is what I call the project summary, which is more specific to the deal at hand. Okay, so those two, to me, demonstrates that you know what you're doing. It showcases your project, and it differentiates you from other people. It lets people know you're serious, and you've thought through all the different scenarios associated with this project. Okay. Number three is do shop around. The first guy lender is not always the best, and don't settle for the first one. It may be the best, but there's no problem. There's no harm in, I think, shopping around, getting one or two different quotes as well. Different lenders have different terms and different interest rates, and and so you want to explore different banks, local banks, credit unions, online lenders, private lending institutions. There are different sources of financing that you may want to explore. So shop around and don't always select the first guy. You could be able to compare the offerings of these people, and then you can then select the one that makes the most sense to you, the one that aligns with what you're trying to do, and it aligns with the needs that you have and what you're trying to accomplish. Okay, so am I good so far? Hopefully this is helpful. If it's helpful, please give me some thumbs ups and let me know that you appreciate what I'm trying to do. And again, if you got some questions, please put them in the comment box, and I will try my best to answer them very, very shortly. Put them in, and we're going to do the Ask Dr. Joe very, very shortly. Number four that you want to on the do is you may want to consult what we call a mortgage broker. These are people who have access to multiple financial institutions. They're not just deal with one entity or one bank. They got access to multiple lenders, and therefore they can shop around. And based on their understanding of what your needs are, they may be able to recommend different sources of financing. Okay, so they can find out which loan option makes the most sense for you in the situation that you're trying to accomplish. They can also help you in terms of the application. They can help you pull this stuff together in terms of the application, and therefore hopefully helping you increase the chances of the loan being approved. Another one do is do save for a down payment. I mean, they want to know that you got skin in the game. They expect you to have some down payment money. And obviously, different lenders have different down payment requirements. But you can't expect them to provide 100% financing. It's unrealistic. Each financial institution is expecting that you bring some money to the table, you have skin in the game, and therefore you want to make sure you have a decent down payment. It could be 5%, 10%, 15, 20%, 25, 30%, depending on the lender. But they expect you to have some money and some down payment money. So, and what it does is that it shows that you're financially savvy and responsible because you've been able to, get this money together. Another do is prepare your financial documents. The lenders will ask for certain documents from you. They will. And whether it be tax returns, whether it be bank statements, whether it be proof of income, whether it be, information about your existing debts, they're going to ask information about you. And so a savvy person, in my opinion, knowing that, will start assembling that stuff beforehand. And therefore, when they meet with the lender, they have it all packaged together, neatly bound, and presented to the lender. Again, it demonstrates to them that you're prepared, you're serious, you're different from all the other characters out there who just show up at the bank, with nothing in their hand. It differentiates you from the potential competition. It does make you look good in their eyes. And the other thing is to be honest, about your finances. You don't want to fudge the books. You don't want to lie. You don't want to exaggerate what you have. You don't want to do what we call a Donald Trump, where again, I'm not trying to get into politics, but he's into a lot of trouble right now because, quote unquote, he's been accused of exaggerating his assets. And so you don't want to do that. You don't want to lie about your finances. These are federal banks, federal institutions, and they're not just going to take your word. Typically, they're going to want some, trust but verify. They want to verify what you have. So, so if you lie about it, there's a pretty good chance you're gonna get caught anyway. So be serious, and if you commit fraud, then there's some serious consequences of that. So it's not worth it. Your situation is your situation. There are things that you can do to overcome some of the challenges that you may have, getting partners, private investors, credit investors, and so on. There's ways to overcome if you don't have much money, but I don't think it's a good idea to lie. And so honesty is always good. Be honest about your income, your debts, and other financial obligations. They're going to pull a credit report, and so they're going to find out, and they're going to ask for statements from your mortgage company. They may ask for your tax returns and so on. So all that stuff will be uncovered, as part of the due diligence process for them. Do get it pre-approved. So it's always a good idea to get pre-approved beforehand and to get pre-approval letter that strengthens your position when you negotiate. And it shows sellers that you're a serious buyer. You've got your financing in place to do the deal. And do communicate clearly. Another do. Clearly communicate to your potential private investors, your banks. Explain to them how you intend to repay the loan. And it builds transparency and it builds trust. When I do the refinance, I always provide them with, for example, statements from the housing authority to prove the kind of rents that I'm going to be getting. And I have a lease in place that proves the income stream that's coming in. So, communicate clearly to the banks as part of that whole transparency and so on. And finally, do seek legal and financial advice if you need it. If you need to, speak with an attorney, a CPA to get some guidance, then get it. You need to understand the terms of your loan. There's a lot of fine print in there, so you want to make sure that you're not that you understand what you're getting into. And also, if you seek legal advice and get good tax advice, they can raise red flags for you because they are what we call fiduciary, fiduciary, and they're supposed to be looking out for your interest as opposed to their own personal gain. So again, that's the do's. We're going to go on to don'ts. So if you got some questions, please put in the chat box. We're going to get to it very, very shortly. I'm going to try and quickly go through the don'ts. There's 10 of them. And, and let's see how far we can go. So the don'ts, let's talk about the don'ts. Don't overlook your credit report. I said look at your credit report. Don't overlook your credit report. Regularly check your credit report for errors. There are errors, in a lot of people's credit reports. So you want to check it. If there are errors, you want to appeal it. And, you want to make sure that those inaccuracies are promptly corrected because they could negatively impact your credit score. Don't ignore, your debt to income ratio. Lenders look at that. What's the debts that you have and what's the income that you have, and they put together a ratio. On commercial loans, they call that DSCR, debt service coverage ratio as well. So be careful about taking on new debts when you're trying to apply for a loan, because if you suddenly get new loans when you're applying for a loan, it doesn't look good. It's going to get flagged, and the lender may deny your loan because it looks like you're shopping around for more loans. You're going to increase your debt load and so on. So if you're going to apply for a refinance or an acquisition loan or whatever it is, try not to take on more additional loans during that time. If you do, then make sure you do it at least 90 days before you make your application. Let's have a look. Number 3, don't make large purchases before applying. So yeah, again, same kind of thing. Don't do big ticket purchases like a car, another house. That's going to increase your, debt to income ratio because that may impact your ability to qualify. Again, it's almost common sense. Hold off on any significant expenses until after you secure the loan and have been approved. Okay. And number 4, don't apply for multiple loans simultaneously. You don't want to go for 3 loans, 4 loans at the same time. You're thinking that you could be fooling the system, but if they find out, then it looks like you've increased your debt load again, and which means that your debt to income ratio is going to be off balance, and you may get denied. So every loan that you make typically is a hard inquiry. So they'll know you're up to something because there's going to be a lot of inquiries taking place. And multiple inquiries, especially within a short period of time, it can signal financial instability to lenders. It doesn't look good. Number 5, don't skip the fine print. Read every clause on the loan carefully if you don't understand. Understand things like interest rates, the repayment schedule, penalties, and any hidden fees. It's not good to be surprised. Number 6, don't fudge the numbers. Don't inflate your income or underestimate your debts. Lenders have a way to verify that information. And if there are discrepancies, it can lead to rejection. If you hide loans, they may pull a credit report. They may look for statements. And, banks aren't stupid. They know the tricks that people pull. And therefore, during the underwriting process, they're going to ask you to provide supporting documentation. And that's usually when they catch you out, or when they do a credit report, a credit check, and they cross-reference what's on your credit report to what you are declaring in the application form. Number 7, don't disregard the mortgage terms. Yes, it's important to understand your mortgage terms, if it's adjustable, if there are prepayment penalties, if there are refinancing options. You just want to know. And just be careful that sometimes especially if you have a adjustable rate mortgage, then it may change over time. Number 8, don't make late payments. Obviously, you want to make sure that you pay on time and consistently pay your bills on time because it'll affect your credit report, and it could significantly impact your ability to close, to get approved. I'm sorry. If the lenders see that you don't pay on time, it's not it doesn't bode well for you. Okay. And number 9 is don't forget to establish an emergency fund. It's like a rainy day fund, having some money in reserves. Having some rainy day funds, it shows financial maturity on your part. It provides a safety net in the event that unforeseen things happen. And finally, number 10 is don't rush the process. The process takes time. Take your time to research, to plan, to prepare. And if you're in a rush, haste makes waste, as I say. Haste makes waste. If you're rushing, you could do some. It's just not worth. Just take your time and make sure you get the best terms for the best loan, given the situation that you're in. So that's, my friends, is it. Let me just conclude today's session. Funding real estate deals is very important. It requires a proactive approach, in my opinion. You want to leverage all the different aspects of financing, and you want to be constantly aware of what's out there. The landscape's always changing, so address the fears that you have head on. Understand what financing options are available to you, given your current situation, and develop a strategy to go after it. You can navigate this. It's not difficult. It's not easy, but you can do it. There's money out there, and the money is not going to jump on your lap. It's going to take an effort on your part, but hopefully some of the things which I've shared today will allow you to start the process, to feel confident in the process, to understand what you have to do before you get into the arena. And because we all need money, you can't do this thing without money. There's money out there. It's not easy to get, but you can get it. And hopefully some of the things I've shared with you today will help you on your journey as you try to strive for financial independence. So hopefully that helpful. And that, my friends, is it for the day. If you got some questions, please put them in the chat box and I'll get them to you. I'll get to it shortly. And again, if you want to email me, you can email me at joe@joeasamoah.com. joe@joeasamoah.com. You can obviously reach me on Instagram at Dr. Joe Asamoah, Dr. Joe Asamoah, and also on Facebook. And my friends, hopefully that was helpful. If you like today's session, please give me some thumbs ups and give me some feedback. Let me know what you think of it, and so on. So let me go down to the Q&A, and let's see what we have. Datu, hey man, how's it going? Greetings from Phoenix. Let's have a look what questions you have. I have spoken. Let's have a look. Hold on a second. I have spoken to different lenders who have told me the following. We cannot give you a new mortgage because you can't have more than 3 mortgages. No. Then I had a different lender say it's less than 10. Okay. How does an investor get a new mortgage if they need more than 10 mortgages or just more than any bank will allow? Do you suggest start paying them off? No. You can have more than 10 mortgages. I have more than 10 mortgages. Now, again, let me clarify. When I first started many, many years ago, you can have up to 20 mortgages. These are 20 mortgages that are on your credit report. Okay. And when I first started, then it went down to 10, then it went down to 4, and now it's back to 10. Okay. So you can have 10 loans that are on your credit report. Some banks say you can't have more than 4 from one particular institution. Okay. But generally, you can have up to 10 sort of Fannie Mae, Freddie Mac type loans. Okay, that's on your credit report. After that, then you have to go to other sources of financing. Typically, you'd go to what we call commercial lenders. Commercial lenders typically don't report to the credit bureaus. A lot of my loans are on my credit report. They're in the name of an institution, entity, LLC. I have a personal guarantee. I personally guarantee the loans, but it's not on my credit report. So when you pull my credit report, you won't see these loans. So that's how you get more than 10. Okay. You have to go to alternate forms of financing. And it could be, as I said before, I use a lot of commercial loans or from institutions, commercial lenders. And that's how you get from that. They don't care how many loans you got for the most part. It just depends on your relationship, your financial stability, and so on. So that's how you get more than 4 or 10 loans Dow 2. Okay. So some lenders will say you can only have 4 from our institution. Some say you can have up to 10. And, I'm assuming you have more than 10. So let's not worry too much about if you don't have 10, or if you only got 1 or 2, then don't worry about it. Okay. Let's worry about it when we get to 4 or 10. Then we'll deal with it then. My thing is, why worry about situations that you don't have to worry about? You deal with it when the time comes. Otherwise, you won't do it. So if you've reached the max, then the next thing now is to look for institutions who will fund you regardless of how many properties that you have. And they tend to be more private, they tend to be more local, credit unions, smaller local banks, where you can establish a relationship, and hopefully they can get to know you, you can get to know them, and so on. So hopefully that was helpful. Okay, keep rolling. Have you applied for SBA loans? This is from Roxanne Belil. No, I haven't, Roxanne. I haven't done an SBA loan. Most of my loans are for mortgages as opposed to business loans. And, typically there are either 30-year, 15-year, or 25-year commercial loans amortized over 5 or 10 years. So I haven't done an SBA loan. I'm assuming SBA loans tend to be more business loans, and whereas my loans tend to be more for real estate, and and so on. Is it true I can get business credit without using my personal credit? Yes. Business credit is usually based on, and it's a business line of credit, BLOC. There are some outfits out here who help you get business lines of credit in the business's name as opposed to your personal name. So if you pull a credit report, it may not show up. As I said before, I have business loans. Well, not business loans. These are loans, mortgages, but it's commercial loans in my entity, LLCs and things like that. They don't show up on my credit report. So there are places out there where you can get business lines of credit, get business loans, which you may have to guarantee the loan. But if someone was to pull a credit report, it wouldn't be shown on your credit report. Okay, so hopefully that was helpful. Good question so far. If you've got some more questions, please put them in. It's now 7:45. I've got time for a couple more, and then I'll and so on. So let's have a look. Katie, hi, Dr. Joe. How did you fund your first investment property? Was your first property a large renovation, or did you ease into bigger projects over multiple investments? Okay, he said, quite the dichotomy here. I look forward to having 10 mortgages in the future. Nice job, day 2. Yes, good job, day 2. Yeah, let's not worry about having 10 properties until we get 10 properties, and then we'll worry about it then. Like some people worry about asset protection. Do I need to have this entity established? Do I need to have this sort of asset protection? But they don't have any assets. So let's get some assets first, and then we'll worry about, protecting them afterwards. Let's not put the cart before the horse, as they say. Okay, so go back to Katie's question. How did you fund your first investment property? The very first house I did, I think I took over. I took over somebody else's loan. Yeah, that was the first one I did. I took over this guy's loan, this investor who wanted to just get rid of this house, and I took over his loans, almost that seller financing, and that was a disaster because I realized I inherited some tenants, and tenants from hell, in fact. And then the next one I did, I got a new loan. It was a traditional loan, 30-year fixed mortgage, and I bought the house. We did some improvements. I funded those improvements myself, and then I did a refinance. So I was doing BRRRR 30 years ago, 35 years ago, before the whole notion of BRRRR was invented. At that time, it was, how do I get a house whereby I don't need a lot of money to buy it? I didn't have a fancy name called BRRRR. But essentially, it was a small renovations. I funded that myself. It increased the value of the house, and then based on the new value of the house, we did the refinance, and I was able to pull my money back out and then do it again. So as time went by, I started. I did a lot of the burr strategy for quite some time until about maybe a dozen years ago when I started going private money. By then, if you're using your own money, at some point you're going to run out, and therefore, I was introduced to the whole notion of private lending. It was very scary. It's very intimidating. So I haven't done private lending for that long, or private investors, I suppose. It was a little intimidating, asking people for money. You kind of question yourself, am I worthy? Why should this person give me their hard-earned money? And so on. But I was able to overcome that. And, one person borrowed me some money. That helped me. I returned the money, and then we kept on going. And over time, I was able to establish relationships with quite a few people with money who wanted to fund my deal because I offered a better interest rate than what they could have got, put it in the bank or savings account or whatever it was. It took some time, but now I have a pool of private investors who are willing, because I'm a person of integrity. I keep my word. If I say I'm going to do something, I do it. I always return the money back to them, and so that's how I sort of slowly but surely build my pool of private lenders. So right now, how do I fund my deals? It's a three-part strategy. One is going to banks. Part one, banks will borrow, or commercial lenders or hard money lenders, they'll borrow maybe 70, 75, 80%. And then I got private lenders for, the remainder. And whatever is not, whatever else I need, then I'll use my own money. So my own money is there, but it's not the primary source of money. I try to leverage my limited money over multiple projects by getting financing from other sources. So hopefully that's helpful. That's how I do it. It took some time, but that's what I do. And I definitely know I have a better idea now how to get private money and strategies on how to raise private money. Some of these gurus, when they talk about private money, it didn't make any sense to me. They were just saying, I don't know, just put together a little PowerPoint presentation. I don't know, book a hotel or restaurant somewhere, have a luncheon, and somehow miraculously people will write you a check. I that doesn't work. I mean, the people who I know aren't going to give me their hard-earned money because I have a nice PowerPoint presentation. I don't know who you know, but that's not the way it works. And so it just didn't make any sense to me. So I sort of developed my own approach to raising private money. And maybe I could talk about that in another session because that's a whole nother topic in itself. Okay, let's have a look. Let's keep going. I think I've talked about that one. This one is, are you saying investors can use self-directed IRA, self-directed 401k or self-directed IRA for a down payment of a mortgage, or would this be to purchase the house full price? It's usually a self-directed IRA as opposed to an IRA from your job, because sometimes the IRA or the 401k from your job, usually they won't allow you to self-direct that. So you have to go to another source, usually these other outfits, custodians out there who are set up for self-directed IRAs. So now you can direct where your funds could go. So there are IRAs. Not all IRAs are self-directed IRAs. You don't control where it goes, but there are self-directed IRA institutions that will allow you to do that, and they'll allow you to invest in real estate. They have these things called solo 401ks, which then allows you more control of how the money goes. You don't need a custodian, but there are still rules that you have to adhere to. If you don't then you could be in trouble with the IRS, and the what do you call those people? The Department of Labor, and so on. So anyway, how do I use self-directed IRA? People generally, as I said before, I have private investors. These are people who have money in IRAs. They or 401ks. They transfer into a self-directed IRA, and then they lend me the money from their self-directed IRA for my projects. Okay, so other people lend me money from their self-directed IRA, and for me to do projects. Because I'm in the Washington D.C. area, where houses are 4, 5, 600,000. Nobody has 4, 500, 600,000 to borrow me. So I don't use one self-directed IRA to fund all my deals, as you can see. That's the reason why I go with banks and so on, because they fund the majority, and then I'll have a series of private investors who fund the delta, whatever's left over. It's just not possible for one self-directed IRA in the DC area to fund the purchase of a house full price. Hopefully that helps, Dow too. Just asking for clarity. Thank you. Okay, good. Katie Abiba, only 5 houses. It's thank different banks have denied me new mortgage because of the number. No, there are lenders out there who you can go up to 10. Now, different lenders will put what they call an overlay in terms of their requirements. Now, that could be what you're running into, Dow too. But you may want to go to local banks. You can explain to them what you're trying to do. You can develop a relationship with the loan officers or the decision makers, and they'll be able to tell you what they can and can't do. So some of the big banks won't do it, but some of the smaller institutions can. And I think that's what you may want to consider going to. Some of the local banks in your area in Phoenix, not the big box banks, but some of the local ones who primarily invest in the jurisdiction that you're located in. And they understand the local environment. They know that, they know the Phoenix area, if that's where you are. They do business in the Phoenix area, and that's all they do business. And you can start developing relationships with key people at the institutions. Okay. But you can definitely get them. And I've had loans, 4 or 5 loans from one institution. And also what you want is lenders who, what do you call that word? Portfolio lenders. There you are. Portfolio lenders. These are people who are going to keep the money on their books, as opposed to selling it to the secondary market, like to Fannie Mae, Freddie Mac, and things like that. So you want these local banks who keep the money on their books, the loans on their books. That's something also you may want to consider, Dow too, as you shop around for lenders. But the lenders are out there, and you do not need to be limited to 4. You do not need to be limited to 5. You can go higher. You can go to 10. And after 10, you can get more than that. And I'm proof of that because I have more than 10 loans and so on. Okay. What are your thoughts on utilizing grants, subsidies, programs offered to affordable housing providers, local housing incentives like LIHTC? That's the low income housing tax credit. That's what it is. LIHTC, low income housing tax credit. I think that's what it is. I haven't utilized some of these grants programs, but I know they're out there. And definitely if there's cheap money, free money out there that's offered by the government, and if there are grant programs out there, you definitely need to look into them. I've had I don't have low income housing tax credits. I've never really participated in those, but I know that there are those sources of monies out there. And if you have the wherewithal to understand how to get it, it's not going to detract from what you're trying to do. it definitely may be worthwhile to explore. I just haven't done it, so I don't have that personal experience, Katie. So, but if you do, please let me know how you do. DCC, arriving late from Houston. Grateful to see you, Dr. Joe, pushing this session to the limit. Can't wait to watch the YouTube later. Good, DCC. Hope you're doing well. And look forward to seeing you next time. Try credit. Yes, this is Katie. At Dow 2, please try a credit union. Yes, that's what I said before. You want to go to local institutions, local banks, local credit unions, where you can establish relationships, because the decisions are made at a local level as opposed to at a regional level or a national level with some of those big bank outfits. And it's always good to have an advocate on your side inside these banks who know you, they like you, they trust you, they've developed a relationship with you, and therefore they're going to go to bat for you. Okay, that's the important thing when you have a local bank. You can establish these relationships, and so if there's a gray area, you have an advocate who's working on your behalf, and hopefully will be able to convince the loan committee, whatever that means, to borrow you the money, and they can sort of vouch for you. They can sort of make your case, and hopefully, if there's a gray area, push it past the goalpost. My friends, it's now 8 o'clock. I think I am done for the day. Well, let's just have got one final question. Aaron Tuxon. Hey, Aaron, how's it going? Nice meeting you in person over the weekend. Yes, we had a great time at the event, and we had a great time. Next time, you guys, whenever I do another event, you need to be there. We had a great time talking about landlording, and we did a deep dive, and also we did some great networking and great food. So please come to the next session whenever I decide to do it next. Okay, nice meeting you in person over the weekend. Do hard money lenders write checks in your personal name or LLC? Most of the time, hard money lenders want the loan to be in your entity, as opposed to your personal name. Now, I know there are some hard money lenders that will lend you money in your personal name, but most of the time, they want you to create an LLC or an entity, and they'll borrow the money into the LLC or the entity as opposed to you. So it won't be so much. They're not going to borrow it most of the times to Aaron Turkson. They may borrow money to Aaron Turkson LLC, but Aaron Turkson guarantees the loan. Okay, you're what we call the personal guarantor. So if Aaron Turkson LLC doesn't pay, then they're going to go after Aaron Turkson, okay, the individual. So that's usually how it works for LLC, for hard money. I think we're done. Thank you, Dr. Joe. You're welcome. Please have a virtual meeting. I will try. I may try and do. I got to overcome some of the technical issues. The next event I do may be a live stream, and therefore, if you're not in the DC area, you can still participate. It'll be paid, so you have to pay, but it may be a discounted price for those people, because there are people who aren't in Washington DC area who can't attend but like to attend, and so I'm going to try and explore that. You are an absolute boss. Thank you. Thanks for the kind words, Katie. Thank you, Dr. Joe. Great session as always. Ready? Thank you very much. My friends, it is 8 o'clock on the dot. I will wrap it up for the day, and I will see you next week. And don't forget, if you have any questions, that's what I was saying. Thank you, Dr. Joe. Information is invaluable. You're welcome. My goal is to provide quality information. Please spread the word and tell your friends, associates, put it on your social media network and tell them to tune in every Wednesday at 7 p.m. And finally, if you want to shoot me an email, you can reach me at joe@joeasamoah.com, joe@joeasamoah.com. And I will try to do my best to answer your questions. So, my friends, I will see you next Wednesday, 7 p.m. Have yourself a good evening. Take care.